Oil touched $105. Payrolls fell by 23,000. Inflation is still 3.4%, with energy sharply higher than last year. Put those headlines together, and one frightening word immediately appears: stagflation. But a frightening label is not yet a useful market framework. Textbook stagflation needs persistent inflation, weak growth, and meaningful labor deterioration together. U.S. output still expanded at a 1.5% annual rate last quarter. And unemployment held near 4.1%, hardly a labor market collapse. So the honest answer is no, full stagflation has not clearly returned. However, a genuine stagflationary risk impulse has returned to the market. That distinction changes how you interpret gold, the dollar, yields, oil, and equities. One headline may push them together, the next can pull them apart. Let us build a dashboard that separates shock, persistence, and confirmation. Start with inflation. Prices keep rising faster than the central bank wants. Then add stagnation, real activity loses momentum and household demand becomes fragile. Finally, labor weakens enough to make that slowdown visible in people's income. The three conditions must persist, they do not need to arrive simultaneously. A temporary gasoline spike alone is not a new economic regime. And 1 week payroll report alone does not prove a recession. The dangerous version emerges when price pressure broadens while demand keeps weakening. An oil supply shock can move both sides of that equation. It raises business costs while quietly reducing what consumers can spend elsewhere. The Federal Reserve cannot produce oil or reopen a shipping route. It can only manage demand and prevent temporary inflation from becoming embedded. That leaves three tests: duration, breadth, and damage to real demand. Begin with the physical shock, not with the first candle on your chart. Hormuz oil flows fell dramatically from their pre-conflict level, according to EIA estimates. Brent fell near $69, then surged as high as $105. EIA's $85 third quarter forecast depends on shipping and production gradually recovering. The first pass reaches gasoline, diesel, jet fuel, and household energy bills. The second pass travels through freight, aviation, agriculture, and product distribution. The third pass reaches plastics, chemicals, packaging, and energy-intensive manufacturing. Businesses then choose between absorbing the cost and raising their selling prices. That pass-through is incomplete, uneven, and often delayed by contracts. Higher oil also behaves like a tax on oil-importing households and companies. Money spent filling a tank cannot be spent at another business. Exporters may gain income while importers face weaker margins and purchasing power. Headline inflation usually reacts first, core inflation may respond later or barely at all. Core services, shelter, wages, and inflation expectations reveal whether pressure is broadening. July energy prices fell monthly, yet remain 14.7% higher yearly. That contrast shows why one monthly change can hide a large annual shock. The key variable is how long disrupted flows and depleted inventories remain abnormal. Watch routes, inventories, refining margins, and the oil curve, not one dramatic candle. Now move to labor, where the latest headline deserves attention but also context. U.S. payrolls declined by 23,000 in July, according to the BLS. May and June were also revised down by a combined 103,000. Yet unemployment changed little at 4.1%. Participation fell to 61.4%, down since the start of the year. Payrolls are one survey, while unemployment comes from a different household survey. July also included a large decline in local government education employment. Healthcare still added jobs, although its pace was slower than before. Average monthly payroll growth over the prior year was only 34,000. That is cooling momentum, but the breadth of weakness determines the next label. Check hours, claims, temporary hiring, job openings, and revisions across several months. Average hourly earnings were 3.2% higher than 1 year earlier. Wage growth near that pace does not automatically create a wage price spiral. Second quarter GDP slowed to 1.5% from 2.1%. But private domestic demand grew faster, so the economy was not simply contracting. Labor cooling can reduce service inflation, while oil pushes headline inflation upward. That collision is exactly what makes the current signal difficult. Classify the labor data as noise, cooling, or contraction and demand confirmation. The Fed's dual mandate now pulls in two different directions. In July, policymakers held rates between 3.5 and 3.75. The vote was 9-3, with 3 officials preferring another quarter-point increase. The statement said inflation remained elevated, partly because of energy supply shocks. Raising rates cannot create barrels, tankers, or spare shipping capacity. It can restrain demand and reduce the risk of second-round price increases. But excessive restraint can turn gradual labor cooling into a deeper downturn. Cutting rates could support jobs and demand when growth weakens. Cutting too early could loosen conditions while inflation expectations are vulnerable. Central banks often look through a brief, isolated energy spike. They react differently when the shock persists and spreads into core prices. Persistent labor weakness increases the cost of waiting too long. The real dilemma is timing, not choosing inflation or employment forever. Front-end Treasury yields reveal how markets are repricing the next policy decisions. Long yields also carry growth, inflation, supply, and term premium information. So higher oil does not automatically mean a permanently stronger dollar. And weak jobs do not automatically guarantee lower yields or a weaker dollar. Markets trade whichever risk dominates expectations after all evidence is combined. Build a matrix before you try to predict the next price move. Row 1 records oil direction, shipping conditions, inventories, and persistence. Row 2 records payroll momentum, unemployment, participation, hours, and claims. Row 3 records core inflation, shelter, services, wages, and expectations. Row 4 records Fed pricing, nominal yields, real yields, and the dollar. Scenario 1 begins when the supply shock fades faster than feared. Oil eases, inventories stabilize, and headline disinflation receives another chance. Pressure for additional tightening may moderate if core inflation stays contained. The dollar can lose part of its inflation and yield premium. Gold then balances fading geopolitical fear against potentially lower real yields. Broad equities may breathe easier while energy shares surrender some advantage. Scenario 2 begins when oil stays elevated while labor keeps weakening. That is the clearest route toward a broader stagflationary risk regime. Long yields may carry more inflation premium while front-end pricing becomes conflicted. The dollar then receives support from rates but resistance from weaker growth. Gold receives support from fear and inflation, but opposition from real yields. Confirm the balance by watching DXY and real yields together. If both rise strongly, gold may struggle despite alarming inflation headlines. If they flatten or fall, the same risk backdrop may support gold. Equities face pressure from weaker demand, expensive energy, and squeezed margins. Oil can remain high even as growth cools when supply remains constrained. Scenario 3 begins when the growth scare overwhelms the inflation shock. Oil and yields may fall, while the dollar balances haven demand against rate cuts. Gold often likes falling real yields, but confirmation still matters more than narrative. Do not diagnose an economic regime from one trading session. Create 3 cards: oil persistence, inflation breadth, and demand damage. The oil card tracks flows, inventories, refining margins, and the forward curve. The inflation card separates headline energy from core services and expectations. The labor card combines payrolls, revisions, unemployment, participation, hours, and claims. Add a policy screen for Fed pricing, 2-year yields, real yields, and DXY. On a demo XAUUSD chart, mark one meaningful observation zone. Do not add 10 lines, the purpose is to test acceptance or rejection. Wait for the macro branch and the price evidence to agree. In the fading shock branch, avoid chasing gold if fear and oil reverse together. In the persistent shock branch, require confirmation from dollar and real yield behavior. In the growth scare branch, test whether gold holds as yields and oil fall. Write the exact evidence that would invalidate each prepared branch. Use a small fixed demo risk and calculate size from invalidation distance. If the evidence conflicts, no trade is a valid completed decision. Afterward, review the process rather than rewarding a lucky outcome. The goal is not to predict stagflation first, it is to make fewer improvised decisions. Use the demo link below, build the 3 cards, and test your framework safely.